All right, let's jump right in. Probably the biggest question on any investor's mind is, am I getting a good deal here? And it sounds pretty simple, but trying to figure out if an entire country's stock market is cheap or expensive, well, that's a huge challenge. So today, we're going to break down one really powerful way to get some answers.
So let's kick things off with a market a lot of us know pretty well, the U.S. stock market. Right now, what's the deal? Is it a fair price or is it just completely overhyped? I mean, where would you even start to figure that out? Well, the first step is to look at one key number. And here it is, 27.84. This is the current price-to-earnings ratio, or PE ratio, for the United States. And all this number really tells you is how much investors are willing to pay for every dollar of a company's earnings. So a higher number usually means more optimism. But 27.84, is that good? Is that bad? Is it high? Is it low?
And that, right there, is the million-dollar question. Because on its own, a number like this is, well, it's pretty much useless. It's kind of like if I told you the temperature was 28 degrees. Without knowing if that's Celsius or Fahrenheit, or even where you are, you have no clue if you need a winter coat or your swim trunks. See? We need context.
And that all-important context, it comes from looking at the past. The only way to know if today's price is weird is to compare it to what's been normal before. And this is really the main idea we're digging into today. A market isn't expensive or cheap in some kind of vacuum. It's expensive or cheap compared to its own history.
So, how do we actually measure how far we've strayed from normal? Well, for that, we use a nifty statistical tool called standard deviation, and it's represented by this Greek letter here, sigma. Don't let the name scare you. It's just a way of measuring how spread out a bunch of data is. For us, it tells us how far a market's current PE has wandered from its historical average.
Honestly, the best way to think about this is to imagine it's a weirdness meter. It's that simple. If the needle on the meter is pointing to 0, everything's perfectly average. But if it starts cranking way up into positive territory, things are getting unusually expensive, weirdly high. And if it drops into the negative, things are weirdly low. It's our guide to spotting when things get, well, weird.
Okay, so using this awesome weirdness meter, the analysis we're looking at sets up a super clear grading system. It's basically a 5-point scale that tells us exactly where a market stands, all based on its standard deviation score.
And here's the breakdown. If a market's PE is within one standard deviation of its average, either a little higher or a little lower, it's considered fair, totally normal. If it's between 1 and 2 standard deviations above the average, it gets the overvalued tag. And if it's way out there, more than 2 deviations above, it's officially expensive. And you guessed it, the same thing happens on the downside for undervalued and cheap.
Right, that's enough theory. Theory's great, but let's see how this thing works in the real world. We're going to take this exact framework and apply it to a major global market, India. Let's run the numbers and see what grade it gets.
So, when you look at the key data for India over the last 10 years, you see its current PE ratio is 24.58, and its average over that time was 20.52. But the most important number on this whole slide is the one that our calculation spits out at the end, that standard deviation score.
And that score is positive 1.65 sigma. This right here is the magic number. This is the reading on our weirdness meter. It's telling us that the Indian market is currently priced 1.65 standard units above its 10-year average.
Okay, so let's think back to that scale we just looked at. Where does a score of plus 1.65 fit in?
Well, it's definitely bigger than +1, but it's not quite at that +2 level. So it slots perfectly into one of those specific categories.
Which means, based on this method, the Indian stock market is currently rated as overvalued when you compare it to its own recent past. Pretty cool, right? We just went from a number that meant nothing to a clear, data-driven rating. It's a system.
So now that we've got the hang of this, let's zoom out. Let's pull up the global scoreboard and see what happens when we apply this to a bunch of different countries. Where are the really big extremes right now?
And whoa, this is where it gets really interesting. Look at Turkey on one end. It's just off the charts. It's more than 6 standard deviations above its historical normal. Now, a number that wild usually points to a bigger story, like Turkey's struggles with very high inflation, which can really mess with these kinds of valuation numbers. Then you look at the other side of the coin, and you've got the Philippines, trading at more than 2 standard deviations below its average, putting it deep in that cheap category.
This chart just makes that contrast so clear. I mean, look at this. Turkey's bar is soaring up into what this model calls historically expensive territory, while the Philippines bar is taking a nosedive deep into cheap. It's just a fantastic visual reminder that every country has its own unique economic story playing out.
But of course, not every market is at some wild extreme. Plenty of countries are just cruising along in that fair value zone, within 1 standard deviation of their 10-year average. So markets like China, Mexico, Ireland, according to this metric, they're all acting pretty normal right now.
Okay, we've gone through a lot here, from the basic idea to a global tour. So what's the bottom line? What are the most important things to remember from all this? Let's just boil it down.
Okay, first, and this is the big one, a PE ratio all by itself tells you basically nothing. Context is everything. Second, what counts as expensive for Turkey is a totally different ballgame from what's expensive for, say, the United States. It's always about comparing a market to itself. And finally, our weirdness meter, standard deviation, is just a fantastic tool for spotting when things are starting to get historically unusual.
And this might be the most important takeaway of all. This whole exercise, this entire analysis, it's a report card on the present moment, graded against the past. It tells us where we are right now. It does not, and I can't stress this enough, it does not tell us what's going to happen next. A market that looks cheap can always get cheaper, and an expensive one can keep getting more expensive for a long, long time.
Which leaves us with one last really important question to chew on. If this tool flags a market as historically cheap, does that automatically mean you should rush out and buy it? Is it a sure thing? Or could it maybe be cheap for a very, very good reason? And that, right there, is the difference between doing the analysis and actually making a decision. And it's a gap every single investor has to bridge for themselves.